I'm Jim, and this is History Decoded. The year was 1962. A young man in his early 30s, armed with little more than a balance sheet, a voracious reading habit, and a mind sharpened by Benjamin Graham himself, made a decision that would haunt and define him. He bought a struggling New England textile company out of spite. The company was Berkshire Hathaway, and that young man was Warren Buffett. You wouldn't have known it then, but that angry move, triggered by what Buffett felt was an underhanded tender offer by Berkshire's management, would become the unlikely origin story of one of the greatest investment vehicles the world has ever seen. Not just a company, not merely a conglomerate, but a living masterclass in patience, discipline, and long-term thinking. To understand what Buffett did to Berkshire Hathaway, you have to understand what it was. In the 1950s and early 60s, it was a dying textile mill, not an empire. A dusty relic of America's industrial heyday, clinging to life while the industry shipped off to the South and then overseas. Its stock price was pitiful, its operations inefficient, its future non-existent. But Buffett didn't care about fabric or factories. He cared about numbers, more specifically assets undervalued on the books. Hidden gems locked behind rusty doors. After gaining control of Berkshire in 1965, Buffett made a fateful decision. He started acquiring insurance companies. It began with National Indemnity. What Buffett had discovered was a loophole in the machinery of capitalism itself: float. Insurance companies collect premiums up front and pay claims later. That money in the meantime just sits. But in Buffett's hands, it didn't sit. It compounded. Using float as his rocket fuel, Buffett began building a portfolio not of stocks, but of dynasties. American Express, a brand bloodied by scandal and saved by Buffett's faith in its fundamentals. Coca-Cola, dismissed by analysts for being too simple, too sugary, too old-fashioned. Buffett saw global brand loyalty and gushing cash flows. He bought billions, and he never flinched. Each major acquisition wasn't a gamble. It was a philosophy. He wasn't chasing momentum. He was chasing inevitability. Duracell batteries, BNSF railroads, See's candies, Geico. Each company selected with the meticulous care of a surgeon, but the conviction of a warrior. By the time Apple came into the picture in 2016, it seemed almost like Buffett was breaking his own rules. He had avoided tech for decades. Too unpredictable, too hype-driven. But what he saw in Apple wasn't a gadget maker. It was a consumer goods company, a cash machine with a fanatically loyal customer base and pricing power unmatched in modern history. What most people miss is how deliberate the architecture of Berkshire became. It wasn't just a holding company. It was a cathedral built brick by brick, each acquisition a stained glass window filtering the light of capitalism. It had no headquarters full of strategists or teams of consultants. Each subsidiary ran independently. Buffett wasn't buying control. He was buying trust. And then there was Charlie. Charlie Munger, Buffett's partner in principle, refined the model. While Buffett brought the temperament, Munger brought the mental models. They discarded pure Graham-style deep value plays and focused on quality businesses at fair prices. The duo didn't just evolve value investing, they made it beautiful. Berkshire became a fortress. It could sit on over $100 billion in cash and not blink. When the 2008 financial crisis hit, Buffett played lender of last resort. He wrote checks to Goldman Sachs and General Electric, extracting terms that made even Wall Street bankers gulp. In the bloodbath, Buffett was calm. The market was finally paying him for his patience. Every letter to shareholders became a masterwork of transparency and education. Buffett didn't obscure Berkshire's performance in jargon. He explained it with anecdotes, humor, and humility. He reminded investors that stocks aren't ticker symbols. They are businesses. That time is not an enemy, it is the ally of the disciplined. Berkshire owns businesses that touch your life every day. The power company that lights your home, the railroad that moves your food, the insurer that protects your car, the ketchup in your fridge. And yet, Buffett never sought to be a celebrity. He still lives in the same Omaha house he bought in 1958. He drinks cherry Coke, he plays bridge, he reads a lot. That unchanging lifestyle is more than a quirk. It's part of the doctrine that says investing isn't about adrenaline, it's about ownership, it's about understanding, and most of all, it's about patience. Berkshire is not sexy. It doesn't announce layoffs with fanfare. It doesn't split stocks to juice momentum. It doesn't chase the quarterly cycle. But its track record is undeniable, over 20% annual returns for more than 50 years. That's not investing, that's legacy. When Buffett eventually passes the torch, it won't be a moment of panic. He has long prepared Berkshire for continuity. Greg Abel, the heir apparent, has been managing the non-insurance businesses with the same stoic pragmatism. The lieutenants, Todd Combs and Ted Weschler, have been managing billions and making solid bets. But let's be clear, no one will be Warren Buffett again. Not because others can't learn from him, but because few have the discipline to endure the boredom of success. Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." Berkshire Hathaway is proof of that principle carved in granite. From a dying mill to a $900 billion empire, Berkshire isn't just a company. It is the embodiment of a philosophy, a monument to what can happen when you tune out the noise, stay curious, invest in people, and let compounding work its slow, powerful magic. This has been The Long Game. I'm Jim, and this is History Decoded. Thanks for watching.